Morning, everybody. Thank you for letting me be here today. The Money Show has been really great having me here. This has been my third keynote speech in a row. Actually, the one in San Francisco, George Gilder and I were flying out here together, and I didn't know that until we were at the Denver airport, and we both spent the night there. And I get to the keynote in San Francisco, and I just had time to shower and change, put a suit on. So I was thought last night might be a little deja vu because George and I were not stranded. We were delayed in Charlotte last night, so I did get here. So it's great to be here and get some sleep here in Dallas, and it's great to be here at this event. As you can tell, I am from the South. I'm not from Texas. I'm from South Carolina, but we obviously share that accent, and I'm glad to be here, really in this great state. One of the things I really want to talk about today, and Aaron mentioned two things in his opening remarks, dividends. That's really the main reason that we're going to be talking about REITs. And I do have a master class today at 1 or 1:30 later today, and a panel later today. So there's more REIT content here at the show. But my background is not only REITs, but real estate investing. And a REIT is a real estate investment trust. As you can see here, I've got a site called REITinvestor.com. You can Google that. I'll throw that up here later in the last slide. But I wrote a book in 2016, actually co-authored a book, I should say, called The Intelligent REIT Investor. And there was another book that was a little more famous than my book called The Intelligent Investor, written by the legendary value investor Benjamin Graham. And he's certainly been an inspiration to me, as he has to Warren Buffett, who is Warren Buffett's mentor and teach and business partner at one time. So the reason I titled this book, The Intelligent REIT Investor, is because I wanted to be able to communicate in a REIT format that investors should really consider this asset class because of the strong dividend performance that these companies have been able to generate over really multiple business cycles. REITs have been around since 1960. And by the way, just so you know, I wrote an article, actually a couple articles later in the week. It's this, obviously October, I got the orange tie, but it's easy I get a lot of people confused a lot, or people are confused a lot over the word REIT. So it is pronounced REIT, and it's really easy to rhyme with. So I did Trick or Treat, my favorite REITs. There's a lot of rhyming you can do with the word REIT. So just for many of you who aren't familiar with the pronunciation, that is what we call it, a REIT. But this industry is a pretty large asset class. For those of you who aren't familiar with this industry, or some of you may be, but maybe not enough, it's a $2 trillion industry, and that's in terms of enterprise value, $1 trillion in terms of market cap. So it's a very incredibly large sector. There's 80 million Americans across the U.S. who have invested in REITs through their retirement account. There are 5 really reasons to invest in a REIT, and I want to go through those very quickly with you. So you can understand, the main reason I want you all to be familiar with this particular asset class. First and foremost is liquidity. Unlike I'm sure all of you go home and you like I do, and you watch TV and you see the flip your houses, and there's all types of get-rich schemes on TV or really the internet, and there's all types of crowdfunding opportunities. But this is where I really want to draw the line, because the REITs, at least the companies that we cover, are publicly traded. So that means there's full liquidity. You can buy and sell stock. You can buy and sell these just like ordinary stocks. You don't have to wait to sell your duplex or flip your house and wait for a buyer to come in and get financing. It's a very liquid market. As I said earlier, it's a $1 trillion asset class in terms of market capitalization. So liquidity is really important. You're owning real estate, some of the best institutionally held commercial real estate you can find in the United States and abroad, but you have liquidity. So that's number one. Number two, you have diversification. When you think about investing in private real estate, you may have invested in, say, a house or an apartment complex or what have you, but you don't have that broad diversification that REITs have. So REITs, these publicly traded real estate companies, they own a variety of products that provide that diversification within your portfolio. So one building or one tenant that may close isn't going to disrupt the revenue stream of that entire business because of that diversification. So that's very, very important attribute for REITs. The other area or pillar I want to talk about is performance. And I'm going to touch on that here in just a few seconds. And again, at my master class, we'll go into a lot more detail about performance. But REITs have outperformed virtually all asset classes over multiple cycles. Now, not every year, obviously. Certainly this year, and maybe one of the reasons Aaron's had me at this show multiple times as a keynote is because REITs have really outperformed this year. And I've got a slide updated yesterday before this presentation just to show you the performance of REITs year to date. Not every year, but through multiple periods, REITs have returned on average around 10 to 11% annualized total returns. That's dividend plus price appreciation, total return. Finally is, I guess, the fourth pillar is transparency. Again, being publicly traded companies, you have all types of public reporting that is required by the SEC for these public companies. So you have the ability to look through quarterly reports, which we do on a very regular basis, or annual reports, and you have more accountability with your management team. Last but not least, the fifth pillar, which is really the critical part of this business model. REITs are required by law to pay out at least 90% of their taxable income. Now, I know that's an accounting, some of you may not be familiar with what that means, but essentially that means that REITs, the reason REITs have higher dividend yields as opposed to ordinary stocks or C corporations is because they by law must pay out at least 90% of their taxable income. Most pay out closer to 100% of taxable income. So right now, on average, REITs are yielding somewhere in the high 3.5% to 4% range, and about half of that for S&P 500 stocks. So you've got a higher yield, you've got a very durable income stream because these are rent checks that these companies pay for a variety of tenants. Now this is an interesting, on our website we created this universe, and we call it the REIT Universe. And the shaded planets, if you will, those are all the property sectors that exist within the real estate real estate investment trust asset class. And you can see the larger planet is cell towers. That's a dominant space because there's only two companies actually that exist in the cell tower arena. They're American Tower and Crown Castle. We like them both. They're both really good companies, but they're very massively scaled. So that's why they're larger. The other sector within the universe we call is the healthcare sector, which is a very broad real estate category that includes everything from skilled nursing to medical office buildings to senior living to hospitals. In fact, I was in Dallas about 2 years ago touring one of the facilities for Physicians Realty, ticker symbol DOC. There's their stock name, DOC. They own a very large, almost 1 million square feet medical office building that it's the cancer center that Baylor Healthcare operates. Physicians Realty owns that property and they lease that back over a long-term lease. So medical office buildings is a very desirable class right now. And I like DOC specifically, by the way, as a pick for some of you. But within healthcare, you've got a very broad spectrum of different properties. So that's how large and massive the space is. So again, in terms of diversification, what I think you all should be considering for your investment portfolio, whether you're retired or pre-retired, so practically anybody, even millennials, should really begin looking at this category because of its very broad reach and how you can generate wealth over owning various commercial real estate properties through this REIT structure. Some of this I'm going to use for my master class, so I'm speeding it up because we only have a few minutes here for this. One thing I want to mention to you is this is kind of an earnings profile. We call it funds from operations, and I'll talk a little bit more granularly later today at this class, but this is basically all of the REITs and their earnings profile, what we call funds from operations, a little different nuance for REITs. But you can see how the earnings profile of REITs have really taken off. This is all the REITs that we cover. There's about 200 publicly traded companies here in the U.S., and you can see that since the recession in 2009 and 10, which was obviously pretty painful for a lot of investors, not only REIT investors, but pretty much any financial stock, but that's the performance we've seen. That's the dividend performance. So you're seeing this growing dividend trend where REITs are continuing to grow their dividend streams. This is, as I mentioned earlier, performance. I updated this slide yesterday before I came out here. This is the year-to-date performance return for the Vanguard Real Estate ETF, and better known as VNQ is the ticker symbol. That's the very broad swath of REIT ownership. There's about 165 individual companies that make up this. But if you take this basket of stocks, all 165 of them, and they're overweight via market cap, you can see REITs have returned 25.09%, and actually that's share price, that's not total return. That's actually, so you're probably closer to 27% roughly year-to-date total return. So again, I don't think any other asset class will match this. We've had a great run in REITs. I hope you were listening to me. I write almost daily for Seeking Alpha. I'm the #1 writer there. So you probably, some of you go to the Seeking Alpha website, you may have seen me there. So pretty much daily, I'll be out there writing. Actually, I wrote an article just for Texas. Tomorrow, sometimes I move outside of the REIT world and go into some other companies. I had a buy on CVS last week. I had a buy on Exxon yesterday. Exxon's a great company right now, by the way. But predominantly, we cover REITs. But you can see here, this particular VNQ is up 27% year to date. Last December, we didn't tell everybody to back the truck up, but we came pretty close. And we've got a lot of happy campers here. So right now, I would not consider the space necessarily overvalued. This chart here really shows, if you highlight on your left, there's a column, and some of you may not can see it, but this breaks down on a sector-by-sector basis the performance of all of the categories within the REIT space. The very top of that is cell towers. Again, that returned 48% year-to-date, followed by data centers, 43% year-to-date. One company I got in really early on, right here in Dallas, or outside of Dallas, is called CyrusOne. Some of you may be familiar with CyrusOne. They're a data center REIT actually based here. Their ticker symbol is CONE, C-O-N-E. They were a spinoff of Cincinnati Bell a couple years ago, I think 2013 or 2014. This company, we had a strong buy back in December. Since that time, CyrusOne's up close to 45% year-to-date. That's been a massive pick for us right here in Dallas. One of the reasons or catalysts for that growth has been there's been a lot of potential acquisition activity in the M&A space for CyrusOne. Even Friday, there was some news that KKR and some of their partners were considering purchasing CyrusOne. One of their competitors, Digital Realty, which is one of my favorite data center REITs, ticker symbol DLR. They're based in San Francisco. They've also made a run at CyrusOne. Those two sectors, the cell tower sector and the data center sectors, those have been very high growth. The reason you've seen the performance, the 48%, the 43% total return performance year to date is because of the growth component related to technology. So we call that the trifecta effect. So you got cell towers, data centers, and the tri is the logistics. That's the third part of those legs to the stool that make up the performance. So if you look here at this chart, industrial, which again, pretty much logistics, these are e-commerce companies that lease to Amazon, among others, and Best Buy, all those e-commerce players. They're up 42% year to date. So part of our job is really to look at this universe of REITs, try to select and help investors pick in the right categories. Because when you invest in a REIT, you shouldn't only just invest in one REIT. You should invest in multiple REITs to really build out your retirement account. I'm going to save some of this for my, again, I've got a 1:30. It's either 1 or 1:30. Aaron, can you double check that the master class? I think it's 1 or 1:30 master class. I'm going to go into a lot more detail. This is my book here, published in 2016, The Intelligent REIT Investor. We're actually doing a second edition now next year. There's been some changes since 2016. Obviously, tax reform weighed in on real estate. There were some very positive changes to not only to REITs, but also to real estate in 2016 as it relates to tax reform. There's also been a lot of changes in retail, and that's something we're going to cover in a lot more detail later today. There are some opportunities in retail. There's risk in retail. We drive around Dallas, and you can see there's still a number of store closures and malls that some malls are making it, some malls aren't making it. So we cover those in a lot of detail to really try to help investors find those best REITs who have the best capital to redevelop those malls. So now you can find us, and we've got a Retire Rich with REITs. I wrote an article on Forbes. I've got a newsletter called the Forbes Real Estate Investor. We started that about 5 years ago. We've got several thousand subscribers. I'd love for you all to subscribe or consider it. But we've got a webinar coming up in November. So you can go to my website to find more about that right there. Either my website, bradtom.com, or you can also email me. I usually don't give out my email address, but I decided I would. For anybody who's interested, please email me and we can give you a seat to our Forbes webinar, which comes up in November, Retire Rich with REITs. So I'm pretty much running out of time. I know this doesn't give me a lot of lot of time, and we'll save some questions for later. Obviously, this venue is not for that, but I really wanted to give everybody an overview of REITs. I think it's important for you all to consider this, not just 2% of your portfolio. We like to see somewhere in the 10% or higher range, especially now given the fact that we've seen this kind of the market dynamics with interest rates now flipping back. We think it's a very defensive asset class, and one of the reasons that you've seen the performance numbers that I just showed you earlier. So I want to thank you all for letting me be here today. Again, I'll be at the master class at 1:30 today, so please check that out if you'd like, and I'll be around most of the day. And thank you very much for letting me be here.